Hello, once again, I'm B.R. Schultz. Thank you for joining me. It's the end of week 51, week 52 next week with Christmas. Today I want to look at the big picture for Jan and Feb. Essentially, we've seen a lot of chop. The model predicted a crash using the zigzag model and gold wave. And as I was studying it tonight, there's quite a few things that pop out. So they're very subtle, but nonetheless, just like we saw the crash on December 18th, 19th, there's some other 3 counts on the macro model that are making me think that we could have some choppy markets ahead. And then, as you know, I think that the macro peak is in, and then this cycle's reset is at the end of March. So kind of giving you a hint there that we're looking at a 5-wave type of structure on a daily scale. And so I want to speak about that with you today. The 5-minute gold wave model is doing pretty good. It predicted the bottom on December 19th, which was a crash, obviously, like a 1987 style crash. Obviously not the same in magnitude, but definitely a straight shot down, right? And then a straight shot up here, which is quite interesting. The volatility is crazy. So I wanted to address that and what I think the next 2.5, 3 months is going to look like. So Merry Christmas to everyone. And my user handle I'm trying to align on multiple fronts is brschultzSP500. So TradingView, I've updated my username to be brschultz500, or sorry, brschultzSP500. My username on YouTube is brschultzSP500 for my handle, my @ symbol in front of that for YouTube, for TradingView, and for WordPress. So WordPress is in the works right now. I'll cut over to a new site over the next month or so, and that'll be all my blogs and rants and raves and blah 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 blah, which hopefully not very many of you sign up for. It's more just me ranting and raving, yeah, and dad humor, and talking about Michael Jordan and Elvis Presley a lot. So yeah, but I will, I keep the alerts on TradingView, I think pretty current, and then YouTube videos, obviously I try to keep as refined material as possible in my presentations, because I want them to be extremely accurate. I want it to be really a high quality product on YouTube. Thank you for joining me. Here's QR codes for donations or a PayPal link in the description below this video on the YouTube page. Okay, so you're seeing the graph that you've seen before, basically calling for a bust right into near Christmas, right before Christmas. We saw that. And what I want you to study here, just zoom in on your phone if you can or whatnot, you can see just above the 1, there's another flat spot in the gold wave, or just under the 2, I should say. Just under the 2, there's that flat spot. Between 1 and 2, there's another flat spot, just a little bit higher than where the 1 starts. And then there's yet another flat spot around April to May, if you go straight up, where those gray zigzags are hitting the gold wave. It's another flat spot. So I know it's really minuscule, very small in nature, but I want to jump to the next graph and let you see what it means as far as 1, 2, 3 counts, which you're probably going to hopefully be blown away by, some of you that are newer to my work. But yes, this 1, 2, 3 was calling for a bust into the Christmas time frame, and then I want you to be able to jump back to this graph to look at it. Some of you have bigger screens at home. I have a second monitor, so I can look at it very closely. But I want to leave this on there so you can always come back to this and look at it for yourself. So let's look at the more complicated graph now. Okay, so I've tried to mark this up for you. The yellow trend line creates the original bust that we saw into just before Christmas that we just seen here. And then you see the black trend line, which is just a little bit higher in the gold wave above it with the black numbering. That has a 1, 2, 3, right? Because the gold wave goes flat there. So where it begins and where it ends is 1 and 2. And then 3 is in the same place as it was before. So that creates a bust roughly into mid-January, maybe even Inauguration Day. So that's interesting. And then, to make things even more complicated, then there's another flat spot in the gold wave back in June of 2023. That's the 1 and 2 in light blue. And then light blue 3 is the exact same point as the other 3s. And that projects out to the end of January, early February as a bottom. And then usually the Super Bowl is a peak. So obviously there's a lot of advertising dollars that go into the Super Bowl, and there's a lot of spend, right, to that essentially keeps the markets juiced. And so usually the Super Bowl is the peak in markets. So I don't have the peak model yet, but you can almost see like a 5-wave pattern here, if you will. So you can see the 5 waves that were in the previous cycle, and then if the end of November into mid-December is the exhaustion wave, and then you would have wave 1 up into, let's say, that January 3rd time frame that I made the previous video for. That'd be wave 1 up. Wave 2 down would be into roughly mid-January, Inauguration Day. Wave 3 up would be from Inauguration Day, maybe another 10 days. And then wave 4 down would be into the end of February, or end of January, sorry. End of January would be wave 4 down. And then wave 5 up would be into the Super Bowl. So that's how we could fit 5 waves, a full cycle, into between now and Super Bowl. So what does that mean? That means it's gonna be most likely be extremely choppy. You're gonna have these 10 days of swings where it's choppy, possibly for 10 days down, and then swing for possibly 10 days up. You're having so much volatility, it looks like, over the next month and a half to get to the peak. If you look back at the model back in April of 2023, that I haven't really seen that before. And when I saw it, I was very confused as well. Back in April of 2023, you see how the sawtooth graph goes down, up, down, up, down, up so fast, and it's making like a 5-wave count there of some sort. So it could look very much like that, where markets are churning quite a bit, and then finally hit some kind of burst upwards into the Super Bowl, and then you have your final exhaustion into mid-late March, and that's where I will make more videos for the mid-late March macro low. But that, if you remember from previous videos, that's where I thought that the peak in the markets was occurring near the end of November, early December, and then we would bottom at the mid-late March timeframe. And in order for you to do that, you would need essentially some type of 5-wave structure between now, or the peak at the end of November. You'd reset you'd have the exhaustion wave down, is what I believe we're in right now. And then you'd have like a 5-wave structure in the model to the peak, which would be roughly Super Bowl. And then you'd have an exhaustion or breakdown of markets into mid-late March. So that I think the Fed is going to try to bleed out some of the strength in markets into March, as the S&P is like 1,200 points above the 34-month moving average. So it's like a 30% gap there, that I believe a bubble, if you want to say that, that the Fed, I think, is going to try to bleed it by making the market go sideways, trying to get some of the pressure out of the system, So I think a lot of this going into the next month or two, obviously there's going to be a lot of political tensions and things of that nature, but as far as liquidity, I think the Fed is going to try to do its darndest to try to alleviate some of the bubble, so to speak, into March, as there's this political turmoil going on with the transition of power, a peaceful transition of power, mostly it's been. So yeah. So this is kind of the overview, if you will, of what's going to happen over the next 3 months, 2-3 months. So it could just really be choppy, honestly. It's and like I said, I think the Fed's going to try to either keep markets sideways to lower for the next 3 months to bring markets down to a more friendly position into March. And if you remember, I had Bitcoin and interest rates as well, bottoming around there. So the whole kit and caboodle should be bottoming in mid-late March. So I don't know how low interest rates will go, right? Obviously, I thought the markets were going to have a much longer breaking down into the 23rd, roughly, from the end of November. We didn't really see a lot of that, so it's always a mystery how much it breaks down, or how badly it breaks down. But over time, if you can keep getting the lows of the interest rates, the refi rates, hopefully one is at the point where you can refi. So I'll keep doing that over time, and I'm kind of excited to give you the mid-range jumper model that I've created, that I think is top notch. I think it's a game changer for me. So, but anyways, this is essentially how you get the 5-wave structure in the markets going into the peak into the Super Bowl, and then most likely an exhaustion wave for that 20 business days or 22 business days after the Super Bowl. So in a nutshell, I want to give you an overview going into Christmas here. So thank you so much for watching. If you haven't subscribed, you're enjoying it and you're blown away by the fact that a model in Excel can predict so much. Hopefully you'll subscribe. Hopefully you'll pass my work along. And then also, hopefully, it stays highly accurate and great quality. Like I said, if I don't create good quality, I'm not going to do this. So I need to challenge myself to only put out quality videos. And then again, username is brschultzSP500 for any and all of my platforms that I'm trying to bridge across different social platforms. Until next time, I'm BR Schultz. Thank you so much. Take care. So hopefully you've enjoyed my show today. Warning, this is all forecast use only. Come here. You want to read this for me? What does that say? Forecast?
Forecast.
Use?
Use only.
Only. Right. And what's this say?
Warning.
Disclaimer.
Disclaimer. I am not
A licensed investment professional. That's Latin. So say caveat emptor. Seek professional advice prior to investing. Bears risk
of
financial
loss.
Very good. And so basically this is saying if you ever try to invest in stocks or anything else, you could lose money. Warning, warning, warning. And all my graphs are subject to change. And not all the results are not always the same. Yeah. Thank you for reading for me.
You're welcome.
And that's it for today. I'm BR Schultz. Until next time, take care.